Welcome back everyone to XM.com. Central bank meetings will continue this week. The Reserve Bank of Australia will announce its rate decision on Tuesday. The Bank of England and the Swiss National Bank will decide on Thursday, while a couple of US data releases might also cause some extra volatility in dollar pairs, specifically US retail sales and the flash S&P Global Business PMI figures might be important to watch later this week. At this video, I'll briefly discuss the outlook for pound dollar, Aussie dollar, and dollar Swiss franc. And starting first with pound dollar and the Bank of England's rate decision. The central bank is not expected to cut interest rates. Perhaps inflation data might ease further this week. Analysts expect inflation to fall to 2% on Wednesday. But the data could still be within the central bank's inflation projections, so the data may not affect policy decision, as policymakers expect inflation to heat up later in the year. So if the central bank holds a hawkish tone, if it uses a hawkish tone later this week, we may see a rebound in pound dollar. The pair is currently trading around, not far above the support zone of 1.2645. This is where the 38.2% Fibonacci retracement of this uplift is located, and we can see that the resistance trend line from May 2021 is also within the same region. So a pivot around this level could happen. However, if we look at the technical indicators, we can see that the indicators are all pointing downwards. So downside movements are more likely than upside ones. So a break below 1.2645 could motivate more selling, likely driving the pair down to 1.2560 and 1.2690. Below that, the pair could stabilize near 1.25. Now, if the central bank indeed uses a hawkish guidance, if it provides no direction about when rate cuts will take place, pound dollar might reverse up, and in this case, investors might look for a close above the 1.2743 territory, where this broken support trend line is located. The 1.28 level could be also a key barrier ahead of the 1.2859 high from last week, a break of which could take us up to 1.2920, where this resistance line is located. Now looking at Aussie dollar, the Reserve Bank of Australia is not expected to cut interest rates as well. However, investors will look whether the central bank, whether policymakers are still thinking of rate hikes after the previous policy meeting showed that talk of rate hikes took place. So if the group of hawkish policymakers further grow this time, we may see, Aussie dollar could rebound, and in this case, the 0.6640 level could immediately come into view. This is where the 38.2% Fibonacci retracement of this uplift over here is placed. However, what could be more important for the pair, perhaps a break above 0.6675 and 0.67 might brighten the outlook again, especially if the rally also continues above the 23.6% Fibonacci of 0.6728. If that happens, then I believe that the pair could reach the 0.68 territory. Now from a technical perspective, if we look at the RSI, the stochastic, and the MACD as well, the indicators are favoring downside movements. They are all pointing downwards, so that downfall might continue in the coming sessions. The 0.6570 and 0.6580 region, where the 200 exponential moving average is placed, could support the market. If not, then the decline could continue towards the 0.6535 region, where this constraining line is located. Break below that could then see a test around the 0.65 round level, where the 61.8% Fibonacci mark is located. And finally, looking at dollar Swiss franc, the pair has been trading sideways around the 200-day moving average, and that creates some speculation about whether the pair will manage to stage a new bull run. Well, the Swiss National Bank is not we'll probably discuss another rate cut this week. Futures markets provide a 75% probability for a rate cut. However, if you look at inflation data, inflation in Switzerland has turned up. It has stabilized at a higher level of 1.4%. So probably the central bank might take some time to monitor inflation pressures before delivering its next rate cut. So if that proves to be the case, if the central bank doesn't cut interest rates on Thursday, Swiss franc could strengthen, and that could probably drive dollar Swiss franc down to the downside. Perhaps we may see some stabilization around this tentative support line at 0.8840, a break of which could take us down to 0.8770, where the 50% Fibonacci retracement level of this up leg is located. However, if the central bank cuts interest rates and if US data come in stronger than expected, then the pair might turn up around the 200-day moving average, and it could probably test the 0.8975 resistance territory ahead of the 20-day moving average. Above that, the 50-day moving average at 0.9065, and this shorter-term descending trend line could also block upside movements around 0.9065. Nevertheless, if the rally continues, then there might be another challenge at 0.9135 before we head into the 0.92 territory. Well, from a technical perspective, we don't have a clear bullish bias here, especially after the bearish cross between the 20 and 50-day moving averages, which signaled a bearish trend continuation. And looking at the technical indicators, those are not cannot guarantee a meaningful rebound. So the risk here is still skewed to the downside, and it remains to be seen whether the Swiss National Bank could change that risk. So that's all for this week's important FX pairs. Thank you for watching, and see you next time. Bye bye for now.